Well, on the one hand, I think Mark is right. Crypto's been disappointing because crypto should move with, equity markets, and it should be rallying with software. Software has really started to rally big, and crypto hasn't moved.
Listen, I am done with BMNR for now. I am done trying to bet on a crypto bull market when a crypto winter is here. But give me some nice momentum in the crypto space, outperformance for a little bit. I'm hopping right back in.
What do we say to investors here about BitMine and Ethereum? Let's say I had an $8 million position in BitMine, and it's now trading at around $3 million. What would your message be to me?
Well, it's not the outcome that anybody wants. If someone's buying a company that has is focused and leveraged to an exponential future, you'd want the share price to go up. But I think Ethereum can't escape the fact that we're in a period where price is lagging fundamental.
But what you have to focus on is that Ethereum has now risen for 3 months consecutively. And in fact, if Ethereum closes May above 2100, that would be the third consecutive month. As I'm highlighting here, there's never been a crypto winter where Ethereum has closed up 3 consecutive months in a row. In other words, the fact that we're up 3 months in a row means crypto winter is over. The second is BitMine launched MAVAN, which is the largest single staking operator in the world. We launched commercial service at the end of March of this year. We have more than 14 billion of assets staked, and we're staking about 2 billion of client assets currently, including other tokens, Hyperliquid and Solana and Canton. As you can see, the staking operations are generating quite a lot of rewards for BitMine. Over 300 million today, but on track to be 352 million once we've fully staked. And finally, we reached 4% of the Ethereum total coin supply. BitMine was created on June 30th of 2025, and the first 1% of the Ethereum supply came in August. And as you can see the different milestones here, on April 10th, we reached 4%. Now at this pace, we could reach 5% very quickly, but we actually want to slow the pace of accumulation. But we still expect to reach 5% of Ethereum sometime in 2026.
We got to 4% on April 10th, and we're at 4.5% today. We could get to 5% as early as the end of June, but we may or may not try to do that because we're bullish on Ethereum. I think people would like us to see us feed our purchases, but one of the things that we're also debating is, whether it makes sense to unwind at 5%. So before having to make that decision, instead of crossing 5% and deciding, we're going to take our time. So we'll slow the pace of accumulation till we've decided. And
as a digital asset treasury since last July, we were able to raise several $1 billion of capital invested in Ether, and from day one make that productive. I think what you're going to end up seeing is a handful of Ethereum digital asset treasuries who are professionally managed, who've raised significant enough capital to get actual scale, and most importantly, making Ether productive.
Over here, the fact that the math actually works out and supports the possibility of an accretive share issuance under a disciplined execution scenario, it doesn't prove that management was actually disciplined, right? I want to be honest about that. But the same can be said about people who are throwing these accusations at BitMine. They cannot prove that BitMine were not disciplined in their execution. I think we will only know this as they release their future quarterly results.
BMNR has already proved it can build an Ethereum empire. The coming filing has to prove the empire belongs to common shareholders, because the number BitMine never headlines is not Ether held. It is Ether and recurring cash yield per diluted common share. First, correct the calendar. As of July 14th, BMNR has not announced July 17th earnings or an earnings call. July 17th is the board-declared scheduled payment date for BMNP dividend number 5. The ordinary 45-day filing clock for the May 31st quarter lands on July 15th. No late filing notice appeared in the SEC feed, and none was yet required. A timely notice could extend the filing to July 20th. This is a filing window setup, not a confirmed earnings countdown. The delayed $16 straddle cost about $1.18 through Friday, or 7.4% of spot. That premium covers whole window volatility, including Ether beta and filing uncertainty. It is not proof of a confirmed earnings day move. Now widen the aperture. At the source lock, Polymarket's July 17th noon contract priced about 84% for Ether above $1,800, about 37% above $1,900, and about 6.5% above $2,000. Those are order book prices, not forecasts, and they are not earnings implied. Perpetual futures add leverage, not confirmation. Hyperliquid carried roughly $1.69 billion of Ether open interest. Deribit carried about $278 million. DYDX carried about $15.6 million. Venue contract designs differ, and open interest measures positions, not net bullishness. Leverage is real. Direction is not confirmed. Farther out, the markets price a wide range, not a clean moonshot. Across Polymarket and Kalshi, Ether was priced around 58% to touch $1,500 by year-end. A touch of 1,000 was around 14 to 16%. A touch of 3,500 was 11 to 15%, and 5,000 only 4 to 6%. Kalshi's separate terminal book priced about 31 to 32% to finish below 1,500. Different contracts and venues cannot establish one joint path. The combination is consistent with, but does not prove, a washout then rebound path. BMNR specific market most relevant to the 5% sprint was longer dated and thin. Polymarket priced roughly 5% for BitMine to announce at least 7 million Ether by year-end. From 5.77 million, that requires another 1.23 million Ether, or 21.3%. With only about $7,000 of liquidity, it is secondary color, not consensus. But it echoes Tom Lee's break. The sprint is no longer assumed. The FAR derivatives book splits in two. Aggregated across September through next June, Deribit carried more than 2 calls for every put in gross open interest. Open interest cannot tell us who bought. Covered call inventory can create the same mountain. Across every FAR expiry, interpolated 25 delta puts were quoted roughly 2 to 4 volatility points richer than matching calls. Gross call inventory is large. Quoted downside volatility is richer. The market leaves room for a wide outcome, not a clean verdict. Now the corporate contradiction. From the mid-April snapshot through July 12th, BMNR added 895,180 Ether, up 18.4%. It reported 1.58 million more staked Ether, up 47.5%. Yet the issuer's headline liquidity figures were $719 million on April 12th and $482 million on July 12th, a $237 million difference. The April label was total cash. The July label was cash plus marketable securities, so this is not a like-for-like cash decline. Reported total holdings moved from a rounded $11.8 billion to $11.3 billion. Lower quoted Ether, the liquidity difference, and other marks all contributed. These weekly figures are management reported and generally unaudited. The denominator decides whether that growth was accretive. The April 24th filing reports 2 conflicting point-in-time basic share counts, both roughly 15% above February 28th. If no shares came after that, Ether per share appears higher. That is an assumption. The 10Q must show May 31st shares, the filing date cover count, the issuance bridge, and potential dilution. AP-weighted diluted shares alone are not a current fully diluted denominator. And a $4 billion buyback authorization is not a buyback. The Russell 3000 addition is independently confirmed, and it already took effect. BitMine separately identifies its placement as Russell 1000 large cap in an SEC-furnished release. That can create benchmark-driven ownership and force more institutions to evaluate the stock. It does not create 1 additional Ether per share. The rebalance was a distribution event. The filing is the economics event. On-chain, the scale is even stranger. Ethereum.org showed about 40.6 million Ether staked. BMNR's company reported 4.92 million equals roughly 12.1% of that displayed total. This is a rough scale comparison, not 12% of active validators or one operator controlling the network. The exposure is distributed across MAVAN and staking partners. The strongest on-chain match is not an issuer-labeled wallet. BitMine said 101,776 Ether was deposited in 1 week. 5 March 20th batch deposits total exactly that amount. If that transaction match candidate cohort belongs to the disclosed MAVAN allocation, all 56 validators are active, none is slashed, and consensus balances are up about 458 Ether. Annualized over each validator's active period, that is roughly 2.62%. Measured from deposit date, including the queue, it is about 1.42%. Both omit execution layer rewards and MEV, and neither is adjusted for provider fees, corporate costs, withdrawals, or later top-ups. The candidate cohort is only about 2.1% of BMNR's reported stake. And fully staked is not an instant toggle. That transaction-matched candidate cohort waited a weighted 53 days to activate. MAVAN's PI entry weight estimate was about 47 days. The official MAVAN interface reported roughly 662,000 Ether under stake. That is a platform-wide scope that may include external clients, not BMNR's disclosed MAVAN allocation. BMNR reported 4.92 million across MAVAN and partners. Watch whether the filing discloses its actual allocation, provider fees, realized net yield, and any external client revenue. Staking has the same gap between promise and proof. The last quarter recognized $10.2 million of staking revenue against $75 million of general and administrative expense. At May 31st, management projected a $258 million annualized staking run rate. A run rate is not free cash flow. Then comes BMNP. It closed June 10th after quarter end, so it is a subsequent event burden, not a May quarter expense. The preferred raised $273.8 million net. At the currently declared weekly amount, and assuming all original 3.5 million shares remain outstanding, 52 payments annualized to about $33.6 million senior to common. If every net dollar bought and staked Ether at the latest reported 2.70% yield, those proceeds would generate about $7.4 million a year. That leaves roughly $26.2 million of illustrative negative carry before price changes, MEV, option results, fees, overhead, and taxes. That is a FinSpace's calculation, not company guidance. 5% sounds like ownership. Dilution decides whether common shareholders own the trip. Here is the climax the filing has to answer. 1 filing, 3 outcomes. The bull case confirms if diluted Ether per share rose, recognized staking gross profit, materially closes the recurring overhead gap. Subsequent event disclosures show a credible path to cover the new preferred burden. Buybacks actually occurred below NAV, and management reports control progress in item 4. The middle case is more Ether per share, but a business that still needs outside capital to fund itself. The bear case confirms if the denominator outran the Treasury, stock compensation and overhead swallowed staking income, derivative or moonshot marks hit the quarter, and the buyback stayed on paper. Signal board building not confirmed. 5% of Ethereum is not the earnings result, per share economics are. Own the flywheel only while net Ether and recurring cash yield per diluted common share rise. If issuance, overhead, and senior preferred claims outrun them, you are not owning 5% of Ethereum. You are financing the route to it.